Who are Unacademy's three closest friends? They left an IAS job to start a dream project. So how did things reach the point of a sale? In the silence of the night, an old photo opens on a laptop screen. Three friends are standing together. There is confidence on their faces, ambition in their eyes, and in their minds, a dream that claims it can change the world of education in India. A few years later, that same dream becomes a unicorn, touches a multi-billion-dollar valuation, investors line up, and lakhs of students begin looking for their future on that platform. But the story does not stop there. Suddenly, the market changes, the shine of growth fades, layoffs begin, valuations start collapsing, and then one day, that same company, which had once been called an education revolution, reaches the point where, instead of protecting its independence, it is on the edge of merging with someone else. The question is not just how Unacademy was built. The real question is how the dream project that three friends built with passion reached a place where people started talking about wrapping it into a share swap deal. According to recent reporting, upGrad has signed a term sheet for an all-stock deal to acquire Unacademy, which means the story is not over yet, but the turn has already become very big. Unacademy did not begin from a big office, heavy funding, or a glamorous launch event. Its roots were in a simple idea. If quality education could be delivered to everyone through the internet, then barriers of geography, money, and access to coaching could be weakened. Gaurav Munjal started it first as a YouTube channel. According to Fortune India's 2021 report, Unacademy began in 2010 as Gaurav Munjal's YouTube channel, and later in 2015, it was incorporated as a company. That was the early phase where a content creator mindset was slowly turning into a startup mindset. Gaurav used to explain coding and technical topics, but the real restlessness inside him was this: how to make education scalable, digital, and democratic. Now let's come to those three closest friends without whom this story remains incomplete. The first name is Gaurav Munjal. He became the public face. He was most recognized as co-founder and CEO, and he was the person who took the early Unacademy experiment from YouTube to a startup. The second name is Saini. He is not just a co-founder, but the emotional anchor of this story, because his biography is cinematic in itself. At a very young age, he cracked AIMS, became a doctor, then cleared UPSC, and became an IAS officer. And after that, he made a rare decision that not everyone can make. He left a government job and jumped into a startup. The third name is Hemesh Singh, who is considered the technical backbone. Gaurav and Hemesh had worked together earlier as well, and Hemesh's role was very important in making Unacademy strong as a technology platform. In public profiles and company-related references, the founders of Unacademy consistently appear as Gaurav Munjal, Saini, and Hemesh Singh, while some historical references also mention early contributors or board-level roles like 𝐮𝐻𝐿 or Sachin Gupta. But the popular founder trio is identified by these three names. Saini's story gave Unacademy not just business value, but also moral legitimacy. In India, IAS is not just a job. It is considered a symbol of prestige, power, and social success. In such a situation, for a young IAS officer to say that he wants to create a larger impact not from inside the system, but through education, this narrative was extremely powerful for Unacademy's branding. Saini's public journey is widely documented. That he cleared civil services at a young age and later left the service for his startup dream. That is why Unacademy did not feel like just another edtech app. For many aspirants, it looked almost like a mission. It seemed that the platform was being driven not just by profit, but also by purpose. Hemesh Singh's role often appears less in headlines, but the startup world knows that. Behind every visible founder, there is someone fighting the real battle of product, engineering, and platform reliability. Hemesh had been an old associate of Gaurav. According to reporting by the Arc and Your Story, Gaurav and Hemesh had earlier worked together on a startup called FlatChat, which was later acquired by Common Floor. That means Unacademy was not the result of some random co-founder matching. It was an alliance of people who had already worked together and already understood each other's strengths. That is the reason Unacademy was able to scale fast in its early years. Vision, brand credibility, and technology execution came together in one place. The most inspiring part of the story was that these founders identified a huge problem in India's coaching and exam prep market. There was talent here, there was aspiration, there was demand, but access to quality teaching was unequal. For students living outside metro cities and quota-type hubs, it was difficult to reach top educators. Unacademy turned that gap into an opportunity. First free content, then live classes, then subscriptions, then test prep verticals. The company slowly turned itself into an exam prep powerhouse. The COVID years gave this growth rocket fuel. When offline classes shut down and the entire education sector was pushed online, an unprecedented growth window opened for edtech companies. Unacademy rode that same wave. In 2021, after Temasek-led funding round, the company's valuation reached $3.4 billion. That was the moment when the startup ecosystem started counting Unacademy among India's biggest edtech success stories. But the most dangerous mistake for a startup is this: to assume that a boom phase is permanent. In 2020 and 2021, online learning had become a necessity. But after 2022, as schools, colleges, and offline coaching began reopening, a reality check started across the entire edtech industry. Students returned to physical classrooms. Parents saw the limitations of a pure online model. Acquisition costs and retention pressure increased. And companies realized that pandemic-era demand was never going to last forever. Reuters, while reporting Unacademy's layoffs in 2022 and 2023, identified funding winter and profitability pressure as major reasons. In March 2023, the company laid off around 12% of its staff, and before that, in November 2022, around 350 jobs had also been cut. The meaning was clear. The growth story was now turning into a survival story. This is where the first major crack appeared in the from the floor to the sky story. Unacademy did not stop at digital. It also made a big bet on offline expansion. The idea itself was not bad. In India's competitive exam market, the psychological value of offline coaching is very high. Parents can see the building, they can see the teachers, they can see discipline, and admission conversion also often becomes easier through physical presence. But the problem was that company-operated offline centers are capital intensive. Rent, faculty, city expansion, management, utilization, local competition. All of it together eats cash. According to reporting in 2026, Unacademy has now decided to move away from its company-operated offline centers and shift toward a franchise model. Money Control, Financial Express, and other outlets wrote that the company is closing or converting company-owned centers and adopting a franchise-led approach. This meant that the aggressive bet placed on offline did not deliver the kind of return that had been expected. This struggle became even more brutal when numbers came into the picture. According to Entracker and ET's reports related to 2024, Unacademy's revenue remained broadly flat or declined slightly, while losses were reduced because of cost-cutting. Entracker reported 2024 total revenue at around 988 crore and net loss at about 631 crore, while ET reported operating revenue and loss figures somewhat differently based on regulatory filings. There can be minor differences in reporting of numbers, but the broader picture remains the same. The company had moved from hypergrowth mode into cost control mode. Reducing losses is a good thing, but to protect valuation, loss reduction alone is never enough. The market also needs growth, defensibility, and confidence in the future. That is exactly where Unacademy began to weaken. Then came the phase of valuation collapse. In December 2024, reports emerged about a possible transaction with Allen Career Institute. According to Economic Times, Money Control, and other reports, talks were happening at around an $800 million valuation. Pay attention. This was the same company that had touched a valuation of $3.4 billion in 2021. That means in just 3 years, market perception had changed dramatically. Reports also said that the treatment of cash reserves itself had become a point of contention in the valuation. The deal did not move forward. That meant buyers were showing interest, but the gap between founder and investor expectations was too large. By the end of 2025 and the beginning of 2026, that gap became even more painful. An ET report from December 2025 indicated that Unacademy's valuation could fall below $500 million. Coverage of deal talks with upGrad in March 2026 said that initial discussions were stuck around a $300 million valuation, which reflected a drop of more than 90% from its peak valuation. Here, one thing needs to be understood honestly. Final transaction valuation becomes clear officially only when the deal closes and filings come out. But market chatter and reporting were clearly showing that Unacademy's value had fallen far below its peak. This is exactly the point where a startup founder faces the biggest emotional shock. When the story of the company remains big, but the market writes its value as much smaller. In the middle of all this, another event damaged the company's public image. Gaurav Munjal's no appraisal town hall controversy. In August 2024, outlets including NDTV and Times of India reported that Gaurav Munjal told employees in a virtual town hall that there would be no appraisals that year, while at the same time he was wearing a Burberry t-shirt worth about $400. Social media described it as tone-deaf and insensitive, especially because there had already been reports of layoffs before that. For startup founders, perception is often as important as the balance sheet. When employees are making sacrifices, growth is slowing, salaries and morale are under pressure, then a founder's luxury image can trigger backlash very quickly. Business reality may have been more complex, but the public narrative saw it as elite founder versus struggling employees. This raises a big question. Was Unacademy only a victim of the market cycle, or did strategic mistakes accelerate the fall? Perhaps both. It is true that the edtech sector went through a post-pandemic correction, but at the same time, aggressive diversification, offline expansion, acquisitions, branding costs, organization size, and uncertain monetization patterns all increase the pressure. When growth looks unlimited, companies make new bets very quickly. The problem begins when the market normalizes, and those same bets start hanging around the neck as fixed costs. This pattern is clearly visible in Unacademy's story. Pandemic boom inflated ambition, and post-pandemic reality exposed the economics. Now let's come to the upGrad deal, which is the current chapter of this story. According to Reuters and Economic Times reporting from March 2026, upGrad and Unacademy have signed a term sheet for an all-stock deal. Gaurav Munjal publicly said that it is a 100% share swap transaction, and Ronnie Screwvala also confirmed the deal. Reporting also says that Gaurav Munjal will continue as Unacademy's co-founder and CEO. That means calling it simply "it was sold" would not be technically fully accurate.
It would be more accurate to say that Unacademy is moving toward becoming part of the upGrad ecosystem. The deal is structured as a share swap, and an attempt is being made to preserve leadership continuity. This language is important because in the startup world, acquisition, merger, share swap, term sheet, and close deal are all different stages. Then the question arises, why upgrade? The answer is hidden in sector logic. Indian edtech has now entered a consolidation phase after the pure land grab phase. In the boom years, companies were snatching market share from each other. Now they are speaking the language of scale, capital efficiency, cross-sell, brand integration, and AI-led reinvention. Ronnie Screwvala reportedly said that Unacademy had once brought a revolution to the sector, and now something similar could happen again with AI. upGrad has remained strong in higher education and upskilling, while Unacademy's brand runs deep in test prep and educator-led learning. If the integration is done right, this combination could be complementary. If not, it may remain just another defensive consolidation. Ronnie Screwvala's name in this story itself draws attention. According to his Forbes profile, he is on the 2026 billionaire list, and he is widely counted among India's most influential entrepreneurs in media, entertainment, and the startup ecosystem. Popular media often describes him with titles like the richest man in Bollywood, though the business reality is much bigger than that. He has been an investor, founder, and operator. An attempt by such a person's company to absorb Unacademy also reflects the changing power structure of the Indian startup landscape. Now the narrative is no longer only young founders changing India. Now mature capital and consolidation players are beginning to pull weaker unicorns into their orbit. But the most interesting thing is that Unacademy's story is not just a rise and fall story. It is also a story of founder psychology. Gaurav Munjal, Roman Saini, and Hemesh Singh belong to that generation which saw the internet as an equalizer. They genuinely tried to build a major educational mission. They brought quality teachers to lakhs of learners. They made education aspirational, digital, and creator-driven. It would be wrong to dismiss Unacademy's rise as just a valuation bubble, because it changed learning behavior in India. But startup history is cruel. It does not ask how pure the vision was, it asks how sustainable the business model was. And many times, this is exactly the point where idealism and economics collide. The moment when Roman Saini left IIS still feels powerful today because it had risk, romance, and purpose in it. But that is also the irony, that the most romantic phase of a startup often turns out to be the most financially unstable. In the early years, founders speak the language of sacrifice and mission. Later, investors speak the language of growth, governance, runway, and exit. Then there comes a time when founders have to accept terms for their own dream project that they had never even imagined in the beginning. Unacademy's current position is a symbol of that same paradox. The idea was big, the brand was big, the impact was big, but in the end the market demanded discipline.
If this video has taught you something new, do not forget to like and share this video so that this information can reach others as well. Your likes and shares are a source of inspiration for us. If you have any questions or suggestions, please let us know in the comments. It will be our honor to answer your questions and listen to suggestion. And yes, if you like our content, subscribe to the channel and press the bell icon so that you stay connected with every new story. Thank you. GRT Business YouTube channel sources, news from various news agencies, opinion polls and other public sources. We try to ensure that every report and summary is accurate and verified, but we are not responsible for any dispute or error. Our aim is only to provide you with accurate information.